A number of listed companies have been stealing the headlines this month, namely the upcoming float of QR National, which has the market buzzing. For their take on the QR IPO, they should love those kind of talk, and other stocks, we should be watching independent investment expert Roger Montgomery and Simon Bond from RBS Morgans join me in the studio for a double-barrelled look at these stocks. How are you guys?
Very well, Peter. Nice to be back.
Yeah, this is like your money, your call, Switzer style.
Switzer money, Switzer call.
Yeah. Now, QR National, a lot of people ask me that question. You know, with your high-tech way of assessing companies, can you assess QR?
Easy. Yeah,
okay.
I've already done it.
The actual published accounts are there for this government.
Prospectus is out,
yeah.
So we know.
Yeah.
I had the opportunity to chat to Lance Hockridge on air on a radio program, and my assessment is that this is not something that qualifies for my money.
An A1 company, isn't it?
It's definitely not an A1 company.
Yeah.
It's not something I'm going to be investing in.
Yeah.
There's a number of reasons for that. Principally, the main reason is in 2012, assuming the forecasts are all hit, the company will earn something in the order of $369 million net profit after tax. But in that profit is a capitalised, I estimate a capitalised interest expense. So there's more interest that has been paid out but isn't being expensed in the profit and loss. It's going to an asset. And so it's not going through the profit and loss statement. So that profit figure should actually be lower. But let's assume that that's right, that accounting profit reflects economic reality. Then that $369 million, based on what I think the growth in the equity will be from when it lists to 2012, is going to be the return on equity. So when you compare that profit to the equity at that time, it's going to be around 5%. Okay, I can get 6% in a bank account today. I don't need to be invested in a business hoping that in 2 years' time it's going to generate a return that's less than what I can get in a bank account today. Yeah. There's some other problems. It's a hugely capital-intensive business. The promoters of the float have made a lot of noise about the great big capital infrastructure spend that they're going to engage in, and it's over $7 billion over 5 years from 2008 to 2012. So they're calling it a growth stock because they're spending all this money. But in 2012, after spending all that money, the cash flow from operations will be about half the amount that they've spent. So they're going to have to borrow to make up the difference, and that's before they pay dividends. So arguably the dividends are being paid out of borrowings, and the dividends are fairly minuscule anyway. You know, they're not really the issue. So the low dividend has some people saying, well, it's not an income stock, it's a growth stock, and they're talking about the growth in the transported coal volumes and that sort of thing, and that's true. All that's growing. And
that would have a reflection in the share price.
That's all right. And China may demand more coal, and QR National is going to transport more coal, and that's all well and good. But I don't have to buy that business and wait for a 5% return in 2 years' time. I can buy businesses today that are at a discount to their intrinsic value that are generating 30, 40, 50% returns on equity. I don't need to be, you know, I can get, as I said, I can get 6% in a bank account, and there's no risk, it's guaranteed. So that's a more attractive proposition for me. So I'm going to keep my powder dry and wait.
Does the role of government in QR National worry you as well?
No, look, I heard one broker today tell me that, look, you know, the reality is, Roger, that that's all well and good, you know, all of the
your numbers,
your numbers, your hocus pocus fundamentals, but the reality is that the government that's floating this wants to be re-elected, and they don't want to float a dud. Well, okay, well, let's look at some other duds that were floated. Qantas has been a dud. It was floated by a government. Telstra has been a dud. It was floated by a government. So while in the short term the share price might go up, and every device available and known to man is being pulled out for this float to support the share price after it lifts.
No Jennifer Hawkins.
Well, everything except Jennifer Hawkins.
She would have actually probably improved it a bit.
Well, yeah, be part of something a lot smaller. So the reality is that the fundamentals of this business don't justify an investment for my money. Now, I'm not making a recommendation to anyone else.
No,
that's just my
view.
view.
The reaction of your potential clients. Are they ringing up and saying, Simon, what do you reckon? Is this a goer or not? They must be asking that question.
There's some people who've already made up their mind who are saying, look, I believe that this is going to be an investment in the future of Asia, the future of China. I'm wedded to the resources sector. I want to be in this company.
It's a bit like backing Bart Cummings in the Melbourne Cup. He's got a good track record of it, and I'm going to play a hunch bet. They're not sure, but they're using those sort of things to drive the investment.
My only suggestion or response to that is that there's other businesses that you would know are more attractive in terms of their fundamentals where you still get that exposure. You know, and you don't, you know, as investors, we have the luxury of choosing which business we want to invest in, and we can choose some businesses that have better fundamentals and have exposure to China.
Hey, but Roger, if for example the external world that you can't predict, like China does demand more, and they actually outperform ASEAN, that would be one reason maybe why the share price could do a lot better than your current calculations.
Hey, Peter, I've got to tell you, and everyone watching this program, I'm not talking about the share price. I'm talking about the business. I don't know what the share
prices can behave irrationally.
Yeah, I don't know what the share price is going to do, and I'm not making any suggestion that the share price is going to go up, down or sideways. I believe the business is worth $1.09 to $1.48.
Yeah.
They're asking me to pay $2.40 to $2.80, not including all the various incentives. So I say to myself, well, there are other businesses that are listed that have higher returns on equity, are going to have less debt in 2012 and are trading at half their intrinsic value. Why would I buy something that's trading double its intrinsic value?
Before we have time,
yes.
Is there a company that on your...
CSL.
CSL.
CSL is a classic business. You know, it's one of the...
You like CSL generally, don't you?
Well, it's one of the great Australian businesses and one of the few fantastic export stories that we have in our listed market.
Yeah.
It's a business that I think is going to do well for a very long time, but because the majority of its earnings are offshore, then the high Australian dollar, and it's reporting in Aussie dollars, the high Australian dollar is obviously a disadvantage to it, and so it looks bad. So short-term traders, they'll be negative on the stock and they'll push the price down potentially. But really, you have to ask yourself: do I think the Australian dollar is going to be $1 or $1.10 or $1.20 for the next 10, 15, 20 years, or do I think it's going to be cyclical like the commodities on which it's based?
Yeah.
And if you think it's going to be cyclical, well, all this does is defer the inevitable success of the investment. So it just pushes it out a little bit further. The intrinsic values are still going up for this company, but they all shift down just a little bit because less profit is being retained to equity, so it's growing at a slower rate. That's the only difference. But it doesn't change the quality of the business at all.